The market will often climb the wall of worry. It's a saying we all know and hold true, but the devil is in the details, and the quote often fails to capture the true essence of the truth. The more accurate quote would be the market climbs the wall of expected worry. And when worry turns into reality, we often get what we did in 2022, a massive sell-off. So today we're going to look at the health of the economy and talk about if and or when future worries turn into present worries and what that means for our future portfolios. We're also going to be covering the latest charts from BofA, market cycle analysis, and what sectors and stocks are stated to outperform in an economy that's simply just roaring ahead. So sit back, relax, and let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe and hit that notification bell. Like this video and leave a comment for the algorithm. You know how the algo works. The more comments you leave, the bigger this community gets. Let's get into it. A very green day across the board. There wasn't actually any news. There was no like macro news or fiscal news or monetary news. That's all coming tomorrow. Today was just like a buy the dip situation led by, a lot of these mega caps, Apple, Microsoft, Nvidia. Comms didn't really participate. Neither did Tesla, but green everywhere. I mean, even defensives put up a good day. Same here with utilities. Defensives were rallying. Cyclicals, sensitives were rallying. This section here in semiconductors didn't participate. Other than that, pretty green day, and it was just a buy the dip situation. I mean, and looking at sectors, GDX down 2.29%. The best performing sector here was home builders on housing data. Housing permits came in above expectations, beat expectations. Really, really good to see that. As well as energy up 1.14%. And a very mixed bag. We had defensives, cyclicals up here. We had home builders, a couple of tech names, software services was up 0.73%. So again, there was no real leader today. It was just, I guess, buy the dip. I mean, let's hop on the charts. I'll show you what I mean. Now guys, let's actually have a look at some of these indices. Look at the S&P 500 up 0.56%, 0.26 for the Nasdaq 100, 0.6 for the RSP. So the broader market gained more than both of the major indices. And then we had mid caps, small caps, and IWM participate too. So it wasn't just a buy the dip in the sectors. It wasn't just a tech rally. It was a broad-based rally in sector and size. Very interesting to see that. Yields did tick down ever so slightly. Bonds were up. Look at Bitcoin, guys, down another nearly 6% for the day. And I believe Bitcoin, let's actually pull up a chart. Just have a real quick look at Bitcoin. I do believe they're very close to correction territory. If we actually go ahead and just measure to, we haven't even really seen like a 15% move in stuff like some of these semi names. I mean, sure, they've pulled back, but they've maintained their momentum. Bitcoin is a 15% pullback is significant. But let's actually talk about the S&P 500. So guys, interesting day of trade. We look at this chart. This is the weekly chart. New all-time closing high for the S&P 500 on the weekly chart, as well as the daily chart. So ever so slightly, just 5180. In the weekend video throughout the week, I said 5090 is the key level that the bears not need, but must go break for us to see any significant downside this week. They haven't been able to do that. And what do you know? We actually put in a higher low and go and make a new all-time closing high bullish. So you don't want to fight this trend, right? You don't want to fight the trend. And I do think that we've done this pretty much every single week consistently, and we're probably going to do the same thing right here. This is probably going to be the low for the next couple of weeks. So you can expect like a pullback above here and then just a continued grind up. It's worked so far, and you don't want to fix anything that's broken. And until we actually go ahead and break this 5090 level, I don't see any downside in this market. And guys, we just made a new all-time closing high. That is super bullish. And look at this candle, right? This is the daily candle. We had a little bit of price discovery below, and then we just pretty much rallied. Very small wick here at the top. All-time closing high. Let's hop on the 5-minute chart just to get a more granular picture. So you can see here, we actually did gap down, had a bit of price discovery down here, and buyers came in a big way, and it was just one-way traffic for most of the day. We did go ahead and make and break some of these key levels right here, violate them. That was towards the end of the day, and then we had dealers buying back their hedges right here, and then we had the 0 DTE end of day run all the way to form a new all-time closing high in the S&P 500. This is bullish. Now we do have a big macro event tomorrow, but I think based on the trade we're seeing right now, based on everything we're seeing in bonds, the market is pretty much priced in 2 to 3 rate cuts. And I think that's what the Fed's going to come out and say tomorrow. We're expecting 2 to 3 rate cuts for 2024. They're going to keep the Fed funds as is. Balance sheet reduction is going to continue as is, and not much is going to change in the market. The S&P 500 rallied after the BOJ raised rates for the first time in 17 years. So this is where we are in the market right now, guys. You don't want to fight this trend. You just want to buy dips at opportune times, and they tend to be the weekly lows. That's kind of where you want to buy it. You know, if we do pull back, you want to buy those tips, look to higher price action. I think 5200 is coming. I think we're going to move up the core gamma resistance over the next couple of days, or in the next week. I think we're going to move to 5300 based on the price action we're seeing right now. And yeah, this is the market we're in right now. Earnings is coming in good. There's just nothing really to take us off course. I mean, we need a massive macro event to take us off course, and the Fed's going to come in on a neutral stance tomorrow. So unless we get like really, really bad data and inflation scare, the labor market deteriorates a lot, this market is going to continue grinding higher. So buy dips, sell rips, guys. Today, we're going to look at a bunch of economic indicators just to see where the US economy is right now. Most of us have our money in US stocks, and it's good to keep our pulse on the US economy. Now, I showed you this yesterday. Fed GDP now sitting at about 2.1, 2.2% at about the blue chip consensus, and that's very, very healthy. We want about 2 to 3% GDP every single year. Now, another fantastic parameter for both the consumer and the supplier that we can kind of look at to get an indication as to where we are in the market is US rail traffic. Now, this is the week 10 data ending the 9th of March. Total intermodal units up 13.5% versus 2023 this week, 5% in total traffic, as well as year to date up 8.5% in total intermodal units, 2.1% total traffic. And rail traffic continues to tell us that things are looking really good, especially compared to 2023. We can see an uptick here, total traffic, and that's exactly what you want to see. And also, you have to understand that total traffic is normally 2 to 3 weeks a leading indicator because suppliers are getting materials here for the upcoming Easter period. And based on everything we're seeing right here with total intermodal units and total traffic, things are looking good for both the consumer and the producer. Moving on to the labor market. This is all Goldman data, by the way. Expect payroll growth to slow to 150K per month, but remain above their 125K per month estimate of the break-even rate this year. So you can see that payroll growth was significantly high here in the 250, 200K, 300K per month. It is now then going to slow to about 150,000 jobs created every single month throughout 2024, and we should see that figure level out about September, October, November. So if we do see job numbers look weaker on a month-over-month basis, that's okay. It's to be expected. It's what the market is pricing in right now. Now, the labor market is a massive indicator to watch. This is very, very interesting data I found. Goldman Sachs statistical model suggests that an unexpected labor market deterioration is the strongest predictor of earlier rate cuts. We see a deterioration right here in the unemployment rate. That's when we could really start looking at potential rate cuts coming into the market, particularly in soft landing environments. Other factors that they do look at is core inflation, GDP growth, and policy rate. And that's exactly what we're looking at right now, guys. GDP, inflation, unemployment. These three things are the major drivers of rate cuts and the economy as a whole. And that's why we're kind of looking at them today. Now, on a more granular level, what does this look like? Now, we can see that an increase in the unemployment rate would justify full pricing of consecutive 25 basis point rate cuts starting in June through the indicated month. So essentially, what BofA is telling us here is that if the unemployment rate was to rise 0.1%, it's currently at 3.9%. So if the unemployment rate was to rise to the 4% level, that would justify a 25 basis rate cut here in June. And then again in July, August, if it was to rise to the 4.25, 4.3 level, and then again here in September to the 4.3, 4.35 level, that would justify the oncoming rate cuts for 2024. So essentially what this data is telling us is that if the unemployment rate was to rise between 4 to 4.1, 4.2%, that's when we can look at rate cuts materializing in as early as June, July 2024. So what are the market expectations for cuts? Now, Goldman expect 3 cuts. They previously had 4. They expect their first 25 basis point cut here in June, and then 25 basis points worth of cuts every other quarter through to 2025, with a terminal rate, as you can see in 2026, of about 3.25 to 3.5. And it's about in line with market expectations. The market expects about 3 cuts, about 70 to 75 basis points worth of cuts. Now, all of this considered, because of the strong economic backdrop, Goldman Sachs expects GDP growth to actually accelerate. You can see here that this is what they previously were. This is what their forecasts. See that this red dot here was their prior forecasts, and this blue is actually what they expect right now. So GDP for Q1 is expected to stay at 1.6, and then an acceleration to 2.7% here in the second and third quarter, and then 2.4% in the fourth quarter, for a quarter-over-quarter change in 2024 of 2.4%. So the fact that the labor market's staying tight, GDP is coming in line, and that the unemployment unemployment rate is in line, they do expect GDP to slightly accelerate. It's nothing crazy, but considering the fact that we were looking at a recession just 6 to 12 months ago, these numbers are kind of crazy. Now, a stronger economy is going to have flow-on effects for inflation. This is Goldman Sachs core PCE forecast. Now, they do forecast around November, December 2024 have 2.4% core PCE. You can see that this was their December prediction, this was their September prediction, and because of the stronger economic conditions, they do expect core PCE actually be above their September and December forecasts. However, as you can see, core PCE is decelerating. This is disinflation, and we are moving in the direction the Fed want us to, and that's down towards the 2% mark, as you can see right here. Now, with all of these economic factors in play, BofA believe we're actually in the early recovery phase, and value, small size, and high risk tend to fare well in a recovery. But what stocks should we particularly look at? According to this data right here, deep value factors had the highest hit rate in recovery, and we could see stuff like earnings yield had a 100% outperformance rate relative to the equal S&P 500. Same thing here with forward earnings yield as well as price to book ratio. So essentially, if you find stocks trading under book value and a relative high earnings yield relative to forward and present, they should outperform in the recovery phase relative to the equal weight S&P 500. Another place you can look at is dividend yield, simply because it's inexpensive relative to history. So we essentially just find companies trading at a low forward PE that pay a pretty high yield, and these stocks should be attractively priced. A lot of their earnings are probably decreasing in this environment. However, if they are trading at a discount, you can still get a lot of capital appreciation as well as collect a pretty high yield relative to the stock price. Now, rounding everything out, we have a labor market that's tight, but it's cooling. Inflation is decelerating, but it's above target. GDP is in line at 2 to 3%. And forecast 2 to 3% as well. Rate cuts are on the horizon and in line with Fed's current expectations of 2 to 3 cuts. Now, that's going to change obviously on Wednesday with the dots, but we're going to see where that is. And I still do think the Fed's going to come out and say 2 to 3 cuts this year in 2024. It just depends on the timing of them. And then rail traffic also shows no sign of slowing down. And all in all, this economy is telling us that things are looking really, really good. Sure, there's some things we do need to be wary of right here with the labor market as well as inflation. But, we'll take those issues as they come. And as it stands right now, as I look at the economy, it seems that this is an economy that's poised for equities to do well in. And that's why I say invest in stocks. The economy is really, really good. It's not great. It's not amazing, but it's a good economy considering the fact that, we had a huge inflation scare, a cost of living crisis a year ago. Everybody was calling for a recession. To be where we are right now with this, rail traffic, rate cuts, I think we're in good standing right now. Let's talk gamma. The put support is here at 4,800. 5,000 is the biggest strike closest to this gamma flip zone. The gamma flip remains at the 5,100 level, and between that 50.90 and 5,100 level continues to be a major line in the sand, and a line that we need to watch for the rest of the week for the rest of this window of weakness. 5,200 is the core resistance. A lot of positive gamma. We are officially back in positive gamma. These strikes are really getting big now. These 5,250, 5,300, even the 5,400 strike right here is being built out. So, if these continue to build out the way they are, we might actually see this move up, but it's all dependent on what the Fed's going to say in the next couple of days. I think that's going to be the major driver of flows right now. That being said, we are in positive gamma, so buy dips, sell rips all the way to 5,100. If we do get below here, look at 5,000 or look just above 5,000. This should offer support and for a bounce back. All in all, we are in positive gamma. Buy dips, sell rips, nothing has changed even in the window of weakness. It's just that these flows don't have too much of a significant effect than when they would leading up into OPEX. Now, looking at the bigger picture, this is a very, very interesting chart here from BofA, and it's essentially the presidential cycles and the current S&P 500 price. Now, it's secular bull market presidential cycles and the S&P 500. So this right here, presidential cycle first term, not in first term, and all cycles, is only indexed to when we've been in a secular bull market. Now, BofA believe we're in a secular. Now BofA remain believers in the secular bull market for equities, given the big cyclical correction in 2022. The current presidential cycle is lagging the average and first term secular bull market cycles as of 2/9/24. This suggests that there is room for the S&P 500 to run in 2024. So according to what we normally see in a secular bull market in the first term of a presidential cycle, we are lagging and there is room to run up. So if we do just keep rallying from here, maybe have a minor pullback and just keep rallying, don't be surprised the data suggests that we should. However, if we bring it back to the overall presidential cycle and look at the raw data, we are tracking well above all presidential cycles, first term and not in first term presidential cycles. This is the S&P 500 right here, and you can see after this blockbuster rally we've had since the October lows, it's been nothing but net all the way up. I'm going to read this for you guys. The current presidential cycle is extended when compared to the average and first term cycles as of the 2nd of the 29th, 2024. The average returns for these cycles suggest February to June year 4 levels for the S&P 500 that align with big supports near 4,800, 4,600. Average first term presidential cycle returns suggest S&P 500 5,000 to 5,200 into year end 2024. So they're pretty much saying we have probably only about 100 more points of upside, maybe a little bit of a pullback, but the upside relative to the average presidential cycle is not that much. But in a secular bull market, we are lagging the average presidential cycle. Now let's talk gamma. Now guys, we're going to look at a bunch of charts from BofA. These are institutional technical charts. BofA's technicians draw these up, and they're really, really good because this gives us an insight into the technical analysis that the big boys, smart money, are looking at every single day or every single week. And when we get access to these, we look at them as well. Now this is the NYSE composite versus the cumulative net up volume. The NYSE cumulative net up volume broke out from the year end long head and shoulders right here, here, and here. This is a bullish sign for market volume, suggesting a trend towards accumulation relative to distribution on the broad-based NYSE. So we see the NYSE breaking out, making new highs. At the same time, relative up volume is doing the same thing, meaning that people are buying on the way up and volume is increasing. That's exactly what you want to see. Looking at the S&P 500 and percentage of stocks above the 200 moving day, according to BofA, last week's higher high on the percentage of SPX stocks above 200 moving day average confirmed the cyclical bull market for the SPX from its lows. So they say we're in a cyclical bull market inside a secular trend, and the confirmation here that we made a higher high ever so slightly is the confirmation of this rally we've seen, particularly from the 2022 lows. Now we've been in a secular bull market since 2013. We do actually have bear markets in secular bulls, and we are entering a cyclical bull inside the secular bull, and that confirmation right here confirms that with the S&P 500 moving higher. Looking at the corporate yield average OAS against the S&P 500, a new cycle low for US corporate high yield average option adjusted spread, that is a mouthful, provides a potential bullish leading indicator for a new cycle and all-time highs on the S&P 500. So pretty much credit spreads tightening, moving downwards, S&P 500 moving up. It means that the credit markets are telling us, hey, things are looking good right now. That's exactly what you want to see. Normally when we do get credit spreads widening, well, here the S&P 500 went up, but normally when credit spreads do widen, we normally do see a downward move in the S&P 500. So this confirms this. Looking at the US put call ratio, something I don't really like looking at because of zero DTEs and how they affect the put call ratio, but essentially one risk for late March into the second quarter 2024 is that higher lows on the 5-day put call in March and February relative to the December low may indicate a bearish divergence against the year-to-date higher highs on the S&P 500. So we got a bearish divergence here on the put call ratio while the S&P 500 is moving higher. I don't really like looking at it because zero DTEs really broke the put call ratio in the last 18 months. Looking at the S&P 500 energy sector relative to the S&P 500 weekly chart, energy broke down from a June 22 to December 2023 head and shoulders right here, here, and here relative to the SPX. One risk for energy is that the tactical leadership from mid-January and early February relative lows is corrective against the overhang provided by the head and shoulders top and declining 20 and 40 week moving averages versus the S&P 500. Essentially what they're saying is that we have a head and shoulders right here. We've broken down below like the shoulder point, and we have seen relative outperformance in energy in January and February, but they do think that's going to be short-lived and we are actually going to pull back relative to the S&P 500. That doesn't mean energy does bad or poorly. It just means that the S&P 500 should do better relative to the energy sector. And we can actually see here that BofA do expect energy to actually, as you can see right here, BofA are actually bullish on energy. They say that if we are to break out from this they believe that if we are to break out from this triangle wedge forming, so let's say we do this break out to the upside, right, we can expect a high, a measured move up to 110 to 112, and that would represent anywhere from 15 to 20% upside, but that's predicated on the fact we do actually, break out, use as support, and then move higher. At the same time, inside this wedge, we can actually look to 87.11 to 85.55 as good support. So maybe we do something like this, break out, pull back, use as support, break out all the way high to this level right here. That'll be 20, 17, 18%, something like that. So if we do get that breakout, we could actually see continued outperformance in energy relative to the S&P 500. That being said, we do have to break out from this wedge first, and we can actually see this like move all the way down. We do see energy tends to be very, very volatile because crude oil is very, very volatile. Now looking at the S&P 500, and this is kind of nuts, guys. You know, we just got this cup and handle measured move. We hit the low side of 5,200, and now we got another higher high here that BofA is giving to us. Now the December breakout above 4,600 on the S&P 500 completed the 2223 cup and handle, as you can see right here, that favors the upside to 5,200 and 5,600. So essentially what they're saying is this cup and handle that was formed, we do a measured move. It takes us to a low of 5,200 to a high of 5,600. We just hit 5,200, which means the next upside target is 5,600. However, the January breakout above the 4,800 area does not rule out 6,150, which aligns with the cup and handle trade potential for a secular bull market in a presidential cycle. So according to the seasonality charts I showed you earlier in the video, presidential cycles in a secular bull market can take us high to 6,150. Is it possible? 100%. I've seen crazier things in the market. Is it probable? With valuations where they are, I really don't think so. To move another 1,000 points from here to 6,150, things really have to get crazy. They can 100%. It can 100% get crazy, but it would be, let's just say, there would be complete disbelief in the rally. Just to put it into perspective, from the bottom of the October lows to where we are right now, that's 1,000 points. How crazy has this rally been, right? Imagine another 1,000 points. That would be absolutely nuts. That being said, according to BofA, according to the data, we can actually see 6,150, but the next upside target 5,600. Looking at data, guys. So Tuesday data, we have housing starts, building permits, and then we get the interest rate projections right here, the longer term second year current interest rate projections. We also got the FOMC. So Wednesday is going to be a very, very big day, and do expect very trepid trade, and do expect quite a lot of volatility, especially on this day, especially in these smaller high beta names. And on Thursday, these are the data points we have, but we'll tackle them tomorrow as well as Friday. But if you've made it up until here, thank you so much for watching, guys. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algo. You know how it works. Cheers.